Hello, everybody. Welcome to the Ether Night stage at ETHDenver 2025. Super excited about our panels today. I'm Lauren Halstead, your MC for the day. As soon as everybody's ready and settled in the back, would love to bring out our first panel. But in the meantime, we'll say a second. All right, so to start off the day, we have the VC landscape in 2025, perspectives from emerging markets. I'm handing over to Mickey Graham, our moderator for the panel. Mickey, would you like to come up? You're welcome. Excited to see you. Old friend from Chainlink Labs.
Awesome. Well, can we get the rest of the panelists up here, and then we'll get started. Yeah, you're up. All the mics work. We good? Check 1 2 1 2. Awesome. Well, hello everyone. Really excited to be here. My name is Mickey Graham. I'm the co-founder and GP of a new venture capital firm, Metalayer Ventures. We are a $25 million fund, writing $500,000 to $1 million checks in pre-seed and seed stage protocols and businesses. So with me today up here, I have 4 really great emerging managers. Before we jump into the conversation though, I want to kind of set the stage for where we are today. The crypto venture capital ecosystem is undergoing one of the most dramatic shifts in recent memory. Just 3 years ago in 2022, the industry was flush with capital. According to Galaxy Digital, in 2022, there were over 300 funds announced that raised just about $35 billion. Fast forward to today, just 2 years later, last year, 2024, those numbers had cratered. There were just 79 funds announced last year that raised just over $5-ish billion. So combined, that's a 74% drop in fund count and an 86% decline in venture capital dollars raised. Yet, despite this, the funds represented on the stage today have successfully raised a Fund 1 or Fund 2 and are actively deploying into and supporting the early stage ecosystem. Each of these funds was able to raise in this environment because they had a compelling value proposition and or a thematic differentiation, often in an underallocated area. We'll get into this as well, but I think emerging managers like the ones on the stage today play a critical role in the ecosystem, helping entrepreneurs take bigger risks, providing the first institutional check when larger funds won't, and having the ability to bet on the next wave of crypto innovation. So with that, I'd love to kind of just jump in. Let's spend 30 seconds on intros. If the 4 of you can just kind of introduce your firm, your check size, and some of your focus areas.
All right, thanks, Mickey. Hi, everyone. I'm Alex Lin. I am one of the founding partners of Reforge. We are an early stage fund really focusing on the intersection of Web 2 and Web 3 in the sense that we spend a lot of time looking at Web 2 companies and engaging with founders that are really focusing on addressing a lot of coordination problems and bottlenecks that exist within their respective industries. So this is everything from logistics and supply chain companies and startups to healthcare to obviously finance and identifying crypto and distributed networks as a mechanism to essentially be the substrate for unlocking the solution space for those coordination problems. So for us, we are typically writing the first institutional check into these companies and really kind of bridging the gap with helping them, introduce crypto in a way that really kind of changes the game. So we're really flipping the script, and so I guess not specifically looking at just crypto, but spending a lot of time in the Web 2 side. Our check sizes range from 250 all the way up to 2 mil, and those conversations have been really great because a lot of times the answers that we're getting from founders is, hey, we do not care about crypto and we don't think distributed networks is a great mechanism to enhance our business, and so then we ask why. And so a lot of the answers are around the infrastructure not being mature enough, and so we also spend a lot of time incubating companies that address these infrastructure problems from the crypto side. So that we're kind of like a two-part fund, and my partner and I are joined by a third partner that we've built, an agentic partner called Ava, and she helps with essentially everything around sourcing and helping us with diligence and building out our operations.
Great. Hey everyone, my name is Sunny Parikh. I'm one of the co-founders and managing partner at Reflexive Ventures. Me and my partner, we were previously at Point72 Ventures and come from a very traditional finance background. What we invest in, how we think about the space, we can break it down into three kind of main areas. One, we think the last 10 years and the next 10 years of crypto are going to be quite different. Two, I think to make progress in the space, we're going to have to go beyond the casino and actually invest in real stuff. And three, as a builder or investor, you'll have to figure out a unique kind of go-to-market or your unique value prop to kind of create value. So the way we think about that is, this kind of meme game or the broader game of just kind of token high FTV kind of this gamification is not going to be sustainable, and so you have to move beyond that. To move beyond the casino, you're going to have to actually solve real problems and create value. And where builders and founders understand what the pain points are and think about leveraging blockchain or crypto to reduce the tax on trust and reduce kind of the intermediaries, that is what's going to be sustainable. And in 10 years, we want to be investing in companies, or we want to have been invested in companies that build real solutions that are kind of the next generation of companies leveraging blockchain.
Awesome. I'm Catrina. I'm a general partner of Portal Ventures. What you need to know about us is very simple. We only lead or co-lead. We backed pre-seed stage, very first believer what we were building, and we back one per category, which entails every quarter we really do our homework and dive into the area where we have a right to win and understand the sector, and we pick a winner there and go from there. So easy.
My name is Casey. I'm the founding and GP of a fund called Topology Ventures, which is actually a frontier tech fund. So we do crypto, but we also go outside of crypto. So things like AI and neurotech and more like on the robotics and hardware side as well. And before this, I was an investment partner at Paradigm, and before that, I was an engineer at Google.
Awesome. Well, thank you so much for the intros. So we have 22 minutes. Let's kind of jump into the heart of it. I know this room is probably mostly full of entrepreneurs and founders. So for founders who are raising this year, how would you describe this environment, specifically compared to the markets of yesteryear, 2021 and 2022, or 2023 to 2024? What's the environment entrepreneurs are going out in 2025? Who wants to take it?
Sure, I'll start. I'll frame it from the lens that we look at companies' investments. There's plenty of capital for interesting entrepreneurs building solutions that are creating value in a sustainable way. I think too often, unfortunately, founders are building or pitching, thinking about venture investors as their end customer. And so founders thinking about actual real customers and users and building a real business, there's plenty of capital sources for that and real funds that are doing that. So I think it can be easy sometimes when you're trying to raise money to kind of say what the venture investors want and whether it's a token or this. But if you actually, I think, are building something sustainable, can talk through what is the problem you're solving, how you're going to market to do that, and how your solution is actually creating that value and solving that in a unique way and what your expertise is, there's countless funds. And if you're doing something like that, I'm happy to talk to you as well.
Yeah, anyone else want to take this? I'm curious specifically compared to kind of 2022 and previous boom cycles we've seen. How do you think the current market compares to that?
I think that because we're at a crypto conference, I'll say this, just like the number of tokens has just fucking exploded over the last few years. Somebody told me this yesterday, I think it's true, there's more tokens than there are users in the space. And so we recently did a huge analysis. We're like a really engineering first fund, just given my background. My first hire was a developer I met as an anon on the internet, and then he doxed as a Citadel quant, and we poached him. And we just did this massive analysis on resistance levels in crypto in terms of like what FDVs projects can reach and then sustain. And I don't know if we're going to open source this, but basically I think that the market has changed so much with the proliferation of tokens, and there are these natural resistance levels of where retail is willing to support tokens. And so I think that's the biggest change. I think it really changes monetization. I think it really changes upside. I think it really changes the entry prices we need to be getting in and the amount of ownership you need to own. And then the last thing I'll say on this is like the tokenomics have really shifted because of this, because there's so many tokens, there's like a totally different playbook for exchanges and how the tokens need to flow in order to optimize the probability of success. Yeah.
Yeah, quickly to dovetail on the exchange side, I recently came back from Hong Kong where you do a lot of research on what it takes to reach the distribution platform. And the number of token getting listed collectively across the top 3 exchanges is actually about 10 to 15% of the last cycle. And the exchanges, maybe it's from the regulatory pressure, maybe it's from the fact that they already have too many alt tokens. It's getting a lot more stringent, which, it just, another way of saying, the playbook might be different this cycle.
Wait, what do you mean by, can I ask a question?
No,
What do you
feel
mean
free.
by wouldn't you think it's less conservative now than before? Or like, so why would regulatory be a reason that there's less listings?
Oh, as in up until this point before Trump.
Oh, before.
Yeah.
I see. So
Yeah.
15%.
It's about, it's 5,000 tokens being listed last cycle, and maybe less than 15% is like 100 collectively, so 7%-ish. Yeah, it's pretty insane.
Yeah, I'm also really curious to hear Alex's thoughts on this. These guys are some of the best infrastructure investors that I know, especially coming from Shima, and you guys have invested in a lot of the most seminal infrastructure projects over the past, call it, couple of cycles. How do you feel about the current landscape on the infrastructure side?
Yeah, I think it's starting to shift in favor of. So there's just a lot of noise, and I think we can all agree with that, not just from the token side, but I think a lot of noise with respect to building projects because Vitalik posted something 3 years ago, and you just want to, essentially raise capital from investors that want to support that vision. But then at the end of the day, not, that infrastructure component may not actually be tangible for anything or for other developers to then build upon. And so I think on the infrastructure side, it's easier to stand out with quality, and especially how you attract developers in terms of if you are going further down the stack, maybe if you're building a new L1 or and you're focusing on security versus high performance, then I think it's easier to stand out, and I think people also have to understand this isn't an overnight thing. I think a lot of infrastructure investments have had quick turnarounds because their product is the token. And at the end of the day, they aren't attracting the right developers and nothing gets done. So I think nothing has really shifted, honestly, relative to previous cycles. I think people are just starting to get more jaded, and the filter, the filter for quality has just increased.
Awesome. So looking ahead to 2025, what are some of the sectors you're most excited about? I think, in 2024, we saw the rise of the intersection of AI and blockchains. Casey, I know you've spent a lot of time thinking about this. We've seen some great infrastructure and scaling solutions emerge over the past year. I think Sunny on the consumer and kind of like more consumer application side, I think you guys have been doing a lot of great work there. What are you really kind of looking forward to in 2025?
Yeah, I can start there. Listen, there's a lot of builders building really interesting solutions, whether it's consumer or enterprise, where crypto is abstracted away. Like for instance, one of our most recent companies is a ticketing company, and there's probably a lot of trauma in the crypto world with lots of people trying ticketing, and the challenge is the fact it's not that ticketing can't work and blockchain can't solve kind of the trust tax that most of these large players charge. It's the go-to-market. So most people try doing it in primary, and it's really hard because the market is very complex in the primary, but secondary markets are very interesting and easier to navigate. So we have a company called XP that's a ticketing marketplace where it's the cheapest place to buy a ticket in the secondary market. Cheaper than StubHub, cheaper than any of the others, just because they don't charge a fee. Just the way Robinhood reduced the trading fees from $8 or $10 a trade to zero, these guys are doing that and figuring out other ways to monetize. So I think it's being creative and innovative and understanding where crypto and blockchain can solve that problem, but it doesn't need to be the product itself. And the maturation of the space requires us to move from the technology being the product to technology being enabling and building a lot of interesting products. It's been hard because, as Casey mentioned, all these tokens, and it's an easy way to kind of make a quick buck for a lot of people, and so it's distracting. The casino is, but really building long-term solutions is where we see the path forward. And there's tons of entrepreneurs doing that, and we've invested in companies doing that in payments and doing that in supply chain, and so solving problems where they have millions in revenue from real customers, large enterprises, luxury designers and so on. So that's the opportunity, and there's a whole host of other companies, but I'll let the others share as well.
I recently backed a crypto quantum company that took me 6 months to find because the intersection, the Venn diagram of someone who's been thinking about quantum cryptographer for a long time and understanding crypto plus being commercial enough to make this into a product is really hard to find. But I think the narrative, and I mean, if you think about crypto, people feed on two things. It's greed and fear. We literally have the greed-fear index, right? And so far with the meme coin craze, we see the greed factor come into play. Whereas fear, I think Bybit is just impactful timing for going forward when people capitalize on all of these trading, like how can they perpetuate their gain? I do think the quantum, so effectively what this protocol does is without bridging, without changing a public or secret key, it's a smart contract that's post-quantum locked. So any protocol, wallet, dApps, or even institutions, they can effectively use them and become quantum, post-quantum. So that's something, I think, a security space with the protocol business model, because the equity, this is a whole different can of worm, the equity business model versus a protocol, but the intersection of protocol and security could be quite interesting.
I just think two things that excites me. I think one is obviously the AI stuff, but I think it's really kind of the consequence of what we're seeing with the development of essentially moving from the attention economy to intention economy, and so being able to be proactive with how people essentially engage with agents to derive intent from existing data or previous intents. And so this is not intents in the sense of crypto, but actions, right? And so I think doing that in a decentralized substrate such as on crypto rails, I think is a really fascinating thing to explore. The second is security. So we're not seeing a reduction in hacks by amount, obviously with the Bybit stuff, as mentioned. So I think with security, I've always been very bearish on auditing firms. I think generally we all agree it's a very reactive approach to solving on-chain security, and so security not in the sense of economic security, but I think building out solutions that are similar to aerospace. So the reason why a plane doesn't fall out of the sky if there's an error within the operating system or within the distributed system is because there are essentially hooks, mechanisms that prevent one area from failing and then covering out with another part of the distributed system. And so I think that is one very fundamental implementation that I don't think we've really thought very deeply about when it comes to network design. And so I think that's starting to change, and so that's another area that I'm really excited for.
Okay, I'm going to try to say some things that just to not repeat. Yeah, we were really early to DAI. Like even in 2022, my Twitter bio was crypto AI, and everyone was like, "That's never going to happen." And now it's just funny that like it's such a thing, and it's been a thing, and now it's not a thing again. So I still am really excited about some things in decentralized AI. I think a lot of it is noise. So I don't know. I guess that's not a contrarian take. I think probably the thing that I spend my most time on that is like the lowest overlap with other people is the intersection of neuro and crypto. I think that neural data is the most valuable data set that we don't have access to yet in the entire world. I think it's getting unlocked with like a really interesting technology called transcranial focused ultrasound. And I suspect that we're not going to want Elon to have access to our brains. And so I do actually think, and this isn't like a bit, like I really do think having ownership over our neural data is going to be really, really important for a society developing. And so I don't know if it's going to be like fully decentralized, but I think at least at a minimum, the ethos of this industry will get into neurotech.
Curious, a quick follow-up question, if I may.
Yeah, go for it.
Is there a dependency on hardware and haptics to collect those data?
Yeah. I don't know how much I can share about our thesis, but we think that, so like basically, historically, the neurotech community has relied on EEG, but EEG doesn't have good enough spatial resolution, which means like it doesn't have enough like specific places of the brain to actually like, use that data. So now we have this like new modality that I'm really, really excited about. And yes, there's like a dependency. There's what needs to happen is a wearable company. If anyone knows of any, text me. We need a wearable company that is using like VLMs to take in your world and then pair it with better data with high spatial res. And from that, we can build like a really, really good model around what our brains are actually doing, which is like a total like black box today. Does that answer your question?
Yeah, super cool.
I think one more thing I'll just add on the contrarian side is, one space we've been spending a little bit of time on, we think about like where are there incentives that are the most misaligned, and one of those spaces is healthcare. We have a healthcare system it's a fifth of our budget, and it's partly because incentives are misaligned. And so if you can figure out an interesting mechanic where crypto's magic power is incentive alignment, and figure out who owns that risk, and how they can incentivize the right behaviors to reduce overall costs and drive kind of aligned behavior, there's a massive opportunity to kind of do that, whether it's a direct consumer solution or enabling a lot of these players. So we've seen a few others. Obviously, there's some regulatory challenges and so on, but in general, like if someone cracks that and is building that, we think it's a very interesting space. It's not crypto. The product doesn't even be crypto, but crypto rails can solve a lot of this in a pretty interesting way.
Awesome, thank you. I love it. So we have consumer, neuro, really spanning the gamut here. Really exciting areas. So let's talk about the distinction between emerging managers and mega VC funds. I think a lot of us on this stage came from larger platforms. Casey was at Paradigm, Sunny was at Point72, I was at 2 Sigma. Kind of how should entrepreneurs and founders think about working with smaller funds? What is the advantage to being a smaller and more nimble organization? I know you have some thoughts on this, Al.
Yeah. I mean, capital is abundant, and so we really think about as investors, where else can we provide value? But also at the same time, we are investors at the end of the day, and so I don't expect to know more about a company or a particular product than the founder. And so when it comes to, I guess, value add, I think it more about kind of point of absolute maximum versus area under the curve, right? Like I can introduce the founders to other VCs. I can make introductions, help with marketing, be a thought leader with whatever they're building. But I think for us, given my background with my partner, is to really kind of focus more on the technical architecture and then being very lean, right? I think other larger firms have technical teams that do provide that similar support, but I think I'm whiteboarding with founders on the first pitch call before before we even make an investment, and so I think those conversations are incredibly valuable. That I think at a larger firm, maybe an analyst is getting on instead of the partners, and so for us, we're very boots on the ground, and I think being lean and being more personable has reaped a very special relationship, because at the end of the day, it's a marriage, and getting in at the earliest stage, not just with capital, but intellectual capital, is incredibly important for founders solving incredibly difficult problems.
Yeah, listen, I agree with what Alex said. I think what I'll add is, a relationship between an investor and a founder, it's a marriage, right? And so it's a personal relationship of, is this someone I want to work with? Is this someone that's going to be there? I just understand, and can they actually help? At the earliest stages, you want someone that's a little more hands-on, where that capital means something to them, and that's going to keep them up at night, just like it keeps you up at night, to kind of help build and drive that. As you grow, there's different needs and different funds, so there's not a one size fits all. It depends on where you are in the kind of growth curve. I think, from an early stage fund investor, it's finding the ones that can solve kind of the needs you'll have over the next 12 months, next 18 months, and get you to those milestones. So it's a very personal decision, but I think at the earliest stages, early stage funds have unique kind of product market fit there, and that matters to them. Every investment we make, we're in touch with regularly. It matters and moves the needle. While at larger funds, you can kind of get lost in kind of this whole machine that is about collecting AUM and management fees from that.
Yeah, for us, we are quite specialized. We lead or co-lead, and we are first day backers. So really, there's nothing too early for us. I mean, I'm sure if there are founders out there, they've heard the feedback from larger firms of, it's a little early for us. I mean, nothing is too early for us, and half the company we've backed don't even have a white paper. I'll, hands-on, quite help them. Basically, the storytelling is something that's really missing from a lot of technical capable teams. And from my background, I did probably a little too long staying in management consulting, but I did that for 5-6 years, and storytelling is all I do. This is why that's one of the areas we work very, very closely with the founders. And also just once you have a lead, you start having momentum, and that's the hardest thing to find, and that's kind of where we play, and also being collaborative with many, many other funds to do the same.
Anything else, Casey, you would add?
I think they did a good job.
Great. Awesome. Well, we have 4 minutes left. I think, Catrina, that's a great segue to this last topic, which is tactical advice for entrepreneurs in the room. They are trying to get checks. They're trying to raise rounds. What is the best way to do that? What is the advice you would give the people here who are trying to raise from you?
I have some advice. Here's my advice. I think that the fact that AI is making software commoditized in the end, because it's all automated, and so we'll have this software on the fly. This is not a unique opinion anymore, so I feel like most people in the audience will say yes, but I think what isn't understood is the downstream effects of that. One being that you just do need less capital. Like, you're just gonna be able to build more with less. And what that means is going and getting money from a multi-stage fund is just like actually not intelligent, because for them, you're a call option for them to do a bigger check later on, but you're never gonna need that check, potentially. And so then you're not getting the support you need for the brand, for the option for them to invest in something that you don't need their money for, because you have AI to do all the things that you used to need to hire for. And so it's like actually a really interesting time for EMs, because you definitely should be partnering with people who, as everyone said on this panel, like, are staying up with you at night, are pulling all-nighters. Like, tomorrow I fly back to go literally live in a basement with one of my founders that we just led the pre-seed of, and we're just gonna like take a sprint week and get this up and going. Very few multi-stage funds will do that for you because their incentives just aren't aligned. And so to me, like, my advice is like really, really think critically about how much capital you need to build the business you wanna build, and considering how fast AI is moving, and then pick the partner that you really need to get you fully there. Because I think it's radically changing.
Totally agree. I think two other things I would say is sometimes it feels comforting to reach out to a lot of funds. There's a balance between kind of quantity and quality. And so understanding kind of who your target market, just like you would for your customers, who the right funds are, and focusing on those with some personalization, doing research to see what kind of companies they've invested in, talking through with them why it's a fit, understanding a thesis. The companies that come and talk to us have read our thesis, looked at our portfolio, super impressive, already shows kind of you're prepared. And then as you're messaging, having a clear view on what the product is, what the go-to-market is, how much you're raising. You know, you're not just saying I'm raising $5 million because of this. Like, what is the money gonna go? What the use of proceeds are? What milestone and values are gonna unlock for the next round? And kind of being very thoughtful and methodical in that shows a very prepared mind that's coming there. And I think that first impression, having done that, just speaks volumes.
So yeah, I agree with all of those points, and I think I'll just add that just humanize the experience. I think I speak on behalf of everyone up here that we are investing, especially with the early stage mentality, in the founder, in you guys, and so for us, we want to invest in unkillable founders, because unkillable founders create unkillable companies, and so really let investors know who you are as a person. And I think that, and I think it's obvious, but I don't see it enough, and a lot of times I have to draw it out of them in calls. And so I think if you make that effort and being able to display, why you're doing what you're doing, and why you're equipped to do so, but doing it in a way that really kind of illustrates who you are as a person, it makes our lives easier, and also at the end of the day, it kind of brings out the most important thing. When it comes to diligence, is how do you minimize the execution risk associated to the founder, being able to overcome challenges.
I'll just echo real quick. Unkillable founders, I like that. When you have 3 projects you're working on, you're pitching your 4th, that's not very appealing. So it's like knowing that this is the main thing you're going to be working on, and you're committed for the long term.
Awesome. Well, I think with that, let's go ahead and end it. It looks like we're at time. So can I get a round of applause for our 4 lovely panelists? Okay, thank you so much.
Thanks, Becky.